Hello, this is David at MBA Tutorials, and today we're going to be discussing the capital asset pricing model, or sometimes referred to as the CAPM. The purpose of the capital asset pricing model is to measure the systematic risk of an asset and its relationship to the expected return of an asset. This could be done for a single asset or a portfolio. So, for example, if you invest in a stock, it's going to have systematic risk. And then, of course, you want to measure its relationship with the expected return of that stock. Same if you have a portfolio of stocks, you have 3, 4, 5 stocks, you can actually measure the risk for the entire portfolio. So first of all, what is systematic risk? What do we mean by that? Well, first, systematic risk, let me write it here. Systematic risk is basically economy-wide risks. So this could be, for example, changes in interest rates. So if the interest rates go up, that's going to affect most, if not all, businesses. Let's see, interest rates. Another thing that could affect would be a recession. So if there's a recession in the economy, then the entire economy is going to be slowing down, which is going to affect most, if not all, companies. The other type of risk, we're not focused on that today, is unsystematic. Unsystematic risk is basically industry specific or company specific. So this is where the risk is associated with just one company or a certain industry. An example could be new competition. What's competition? Let's see. I can't really spell today. All right, new competition. Also, it could be maybe poor management. So, for example, if you have a company and you have a new competitor that's making a better product or has better service, then they're going to be maybe taking more market share from you. So that's a risk that's affecting your specific company. Same as if you have a company with poor management, maybe the leadership is not that good. They're not keeping up with the changes in the overall economy. They're not improving their technology, or they're not trying to keep their costs low. That could target a specific company. We're not going to focus on unsystematic risk today. So as we said, the CAPM models measures the systematic risk, and systematic risk we usually refer to as beta. And so I'm just going to put it here, beta. And then we compare that on the y-axis with the expected return. Oops, of the asset. This is what we hope to achieve if we invest in that asset. And so naturally, you can tell that if an asset has more risk, you expect to get a higher return. If the asset has a low risk, then you expect a lower return. And so that's basically what the CAPM model is measuring. Let's go to the next slide. Now the formula is the expected return equals the risk-free rate plus beta of the investment times the market rate minus the risk-free rate. So we have here the expected return of the investment. This is what we hope to achieve to get. Then we have the risk-free rate. Now the risk-free rate we usually refer to as the current interest rate of the U.S. Treasury bills. And they usually sometimes use like a 3-month bill as a risk-free rate. And the reason we call it risk-free is because, in theory, the government treasury bills are the safest investment, and they are considered risk-free. Then we have the beta of the investment. And beta will go into a little more detail in the next slide, but the beta is basically the systematic risk of this particular stock or asset. And then we have the market risk premium. Market risk premium would be your market rate, the rate that the overall market is earning, minus your risk-free rate, which is your treasury bills. And just another note on the beta. Beta can come in if the market has a beta of 1. So the overall market has a beta of 1. If the beta is less than 1, that implies lower risk. If the beta is greater than 1, that implies higher risk. And what that means is that if the beta is greater than 1, then your stock, if your stock has a beta of greater than 1, then it's going to be more risky than the overall economy or the overall market risk. Let's put market right here. All right, let's go to the next slide. Here we're looking at NVIDIA Corporation. And NVIDIA, you can get this information from any financial website. I got this from Yahoo Finance. NVIDIA has a 5-year beta of 2.12. Now I'm not going to show you how to find the beta as far as like doing the calculations. That's more intense and for another tutorial. But the beta is given to you. And so, for example, NVIDIA has a beta of 2.12. Now, as we said in the previous slide, if the beta is greater than 1, remember 1 is the overall market, then that implies that it's a higher risk. And so NVIDIA has more risk than the overall market, which is generally true for a lot of tech companies, because tech companies are doing a lot of research and development, and they're trying to push the boundaries of technology, and so there's more risk associated with that. The next company we're going to look at is Walmart. Walmart, as you can tell, has a beta of 0.69. Whoops. 0.69. And so as we know that this is less than 1, that means there's lower risk. So Walmart is focused on selling groceries and other household goods. So it doesn't matter if the economy is good or bad, people are still going to go out and buy groceries. And so, of course, they're focused on their risk for investing in this company is going to be much lower than the overall market. Okay, let me illustrate this a little bit more in a graphical way. So here we have our graph, and I'm going to use the S&P 500 as an example. So here we have the S&P 500, and of course it goes up, and then later on it goes back down, and then it goes up again through time. And so S&P 500, and since we're using this as the market, its beta is going to equal 1. Okay, so this is the overall market. Now, for our next company, NVIDIA, if you recall, NVIDIA had a beta of 2.12. So NVIDIA, when the market is going up, NVIDIA is going to go much higher than the overall market. And then when the market is going down, the price of NVIDIA is going to go down much lower. So it has a lot more volatile swings than the market. So here we have NVIDIA. Its beta is 2.12. And then for Walmart, we'll put Walmart in red. Walmart, when the market is going up, it's going up, but it's not going up as high. And then when the market is going down, it's not going down as low. And when the market goes back up, it's not going up as high. And it's a little bit of a flatter line. It's not too flat, but it's a little bit flatter when you compare it to NVIDIA. And so Walmart has a beta of 0.69. Okay, that's implying less risk. All right. Okay, now we have a couple of questions. You're more than welcome to pause the video and do these on your own, or you can just simply follow along. So the first question is, a stock has a beta of 1.5. The expected return on the market is 10%, and the risk-free rate is 3.8%. What is the expected return on this stock? So let's use our formula. We have our expected return equals the risk-free rate plus beta times the market rate minus the risk-free rate. So now we just plug in the numbers. So our risk-free rate is 3.8%. So that's going to be 0.038 plus our beta is 1.5. See, 1.5 times our market rate, which is 10%. That's going to be 0.10 minus our risk-free rate, which is 0.038. So now we just could perform these functions in the calculator. That's what I'm going to do. 0.1 minus 0.038 times 1.5 plus 0.038. So we get a return of about 13.1%. So that is our expected return of this stock. So what is that saying? Well, because it has a higher beta than the overall market, this implies more risk, and with more risk, you have a higher expected return. So the market has a beta of 1, its return is 10%, but our stock here has a beta of 1.5, and we have an expected return of 13.1%. All right, let's go to the next question. Okay, now we have question 2, and this is going to be on a portfolio of 2 stocks. So we're going to measure the beta for the portfolio, or not the beta, but the expected return. So it says, suppose you have $20,000 total. If you put $15,000 in stock A, which has a beta of 0.75, and the rest in stock B, which has a beta of 1.25, what will be the expected return of the portfolio? The risk-free rate is 4.0% and the market rate is 8%. Hint, there is an extra step that we did not cover. So it's very easy. first of all, we have to find the expected returns of stock A and stock B. So we're going to start off with stock A. I'm going to use yellow. And we have our formula. Our expected return equals the risk-free rate plus beta times the market rate minus the risk-free rate. So for stock A, the risk-free rate is 4.0, so that's going to be 0.04 plus the beta for stock A is 0.75. The market rate is 8%, so that's 0.08 minus 0.04, and then we just do the figure out what the expected return is. So doing it in my calculator, and we have a return of 7%. Okay, that's for stock A. Now we're going to do stock B. We're going to do that in green. Using the same formula, and I'm just going to write the numbers down. So expected return equals our risk-free rate of 0.04 plus our beta, which for stock B, a beta of 1.25, times the market rate, which is 0.08% minus the risk-free rate. So we simply put those numbers in the calculator and we find out what we have. So 0.08 minus 0.04 times 1.25 plus 0.04, and we have a expected return on stock B of 9%. Okay, so stock A has an expected return of 7%. And if you notice here, let's see, the market rate is 8%, but stock A has a beta of 0.75, which means it's less risky. Less risk means a lower return. And so 7.0 is lower than 8%. And so it's going to be less risky, but also a lower return. Now, stock B, on the other hand, stock B has a beta of 1.25, which is higher than the beta of the market, which is 1.0. And so its expected return is 9.0, which is higher than the market rate. So it has higher risk, potentially higher return. All right, but we have one more step to complete before we can finish, because it's asking for the portfolio. What is the expected return of the entire portfolio? So for that, we have to figure out the weights, and we can do that this way. So we have stock A, and stock A, we put in $15,000, and we have $20,000 total. So we simply take 15,000 divided by 20,000, and then we have our weight, which is 0.75. Same thing for stock B. Stock B, we have, let's see, the rest of it, which is 5,000, divided by 20,000. And that's going to give our weight of 0.25. So for stock A, we have, well, let's see, let's write this down. We have the expected portfolio, or expected return of the portfolio. So I'm going to put expected return. I'm going to put a P for portfolio. We have our weight, which is 0.75. And then we have our expected return of stock A, which is 7.0. So 0.07. And we're going to add that to stock B. And so stock B's weight is 0.25. Multiply that by its return, which is going to be 0.09. And then we can get the expected return of the whole portfolio. So let me do this calculations here. 0.75 times 0.07. That's going to be 0.0525 plus 0.25 times 0.09. That's going to be 0.0225. So we simply add those together. That gives us a total of 0.075 or 75% return, expected return. So what that's saying is that for the entire portfolio, our expected return should be 7.5%. So if we put all our money into stock A, which is safe, we would get a return of 7.0%. If we put all of our money in stock B, we could potentially get a return of 9%, but that means we also have more risk. But if we create a portfolio, if we buy 2 or more stocks, in this case, we have a portfolio return of 7.5. So it's a little bit more than 7.0, not quite as good as 9.0, but that is, we get a little bit more of a return and try to spread the risk by diversifying into 2 different stocks. All right. Thank you for listening to this tutorial, and stay tuned. There will be more tutorials later on a variety of topics. If you have any suggestions or comments, you're more than welcome to make them. And see you next time.